Hey everyone, welcome to another live stream. I hope you guys are doing great. Today we're talking about how there is no signs of a real estate market crash and there's not going to be a market crash. Of course, this is all according to a Yahoo Finance article that we're going to go over today. So you guys kind of know the drill. We've got a couple articles in store. Like I said, one of them is from Yahoo Finance talking about how we really don't see any signs of a housing crash. And then I have another really interesting article that is from more of a financial website that talks about kind of the perspective of buying a house. And the article is framed from the standpoint of like, what happens if you buy a house at the top of the market? What does that mean for you? And what are the implications? So we've got a couple of good articles. Today's stream might be a little bit shorter than normal, but thanks for joining. As always, if you're new to the stream, love to know where you're watching from. Drop a comment in the comment section. Let me know what local marketplace you're in, and if anything that we're talking about, applies to you. Of course, if you guys have any questions related to the stream or real estate in general, just let me know and I'd be happy to chime in. And also, if you like the stream, please drop a like, consider subscribing to the channel. It's free, doesn't cost you anything, and it really does help out myself and the channel and the stream. So let's get into it. So the first one we want to cover today is from Yahoo Finance. And this one talks about when will the housing market crash. We have a lot of people that you're going to hear a lot of people talk about how we need a housing crash and they want a housing crash. And it's interesting because we actually have a large group of people in America that are rooting against other people in America. It's sort of the war between the homeowners and the non-homeowners. And I understand. I understand what millennials and Gen Z are feeling. I get it. Again, being a real estate agent myself, I see it from clients all the time, and my friends as well that are just they feel honestly helpless when it comes to the American dream of owning a home. So I can understand their sentiment. I get why they're frustrated. I get why people might think they want a housing crash to occur. But oftentimes, what people don't realize is that in the event of a housing crash, a national housing crash, a real, actual housing crash, there's a lot of casualties that get hit with damage. It's not just, oh, good news, houses got cheaper overnight and now y'all can afford them. No, that only happens a few different ways, which this article is going to cover. So it's just kind of interesting. Again, these are the opinions of Yahoo Finance, and I'm just kind of reacting to them. Um, do I think there's going to be a housing crash? Now, that's neither here nor there for now. If you want my opinion, I'll give it to you. But for right now, we're just going to analyze what this article is saying, and I'll kind of sound off on what I agree with and what I disagree with. And again, if you agree with something, let me know in the comments. If you disagree with something, let me know in the comments. Love to know what you think. So let's get going. So this is a recent article. Came out just 5 days ago, July 5th, from Michelle Lerner. Again, this is from Yahoo Personal Finance. A housing market crash happens when home values plummet due to a lack of demand for homes or an oversupply. Typically, we classify a crash as is when a certain area is seeing across the board, 20% or more price decreases. Housing market crashes can happen for multiple reasons, such as deep recession or depression, causing homeowners to lose their jobs, high mortgage rates making homes unaffordable, or a glut of available homes that buyers don't want or cannot afford to buy. During the last housing market crash, home prices dropped over 15% in 2008 compared to 2007, according to the S&P/Case-Shiller home price indices. And the Case-Shiller is like that's the one that everybody pays attention to in terms of what the average price of a home is in the United States. So that's a very common metric to use, and it's a very common chart that we see brought up all the time in all sorts of different finance and real estate related articles and news stories and things like that. Skip past the ads here. All right. When will the housing market crash? And right off the bat, there are no signs that the U.S. housing market is about to crash. Again, this is according to Yahoo. I know in the comments, people are waiting to jump on me and they'll be like, you're just a real estate agent that thinks it's never going to crash. This is not my opinion. This is the opinion of Yahoo Finance. Uh, in fact, the economic outlook and expectations for the real estate market nationally are positive for 2024. A housing crash occurs when demand drops dramatically and home values tumble. Unless there is a significant surge in the rate of unemployment, which is currently not in the forecast, the housing market is expected to continue to rebound from 2023 lows, said Selma Hepp, chief economist of real estate data analytics firm CoreLogic, in an email. Now, really important, CoreLogic, again, they just do real estate data. CoreLogic is not a real estate broker. They don't, they're not a real estate website for consumers. They just look at data. So pretty unbiased, if you ask me. They're really just looking at the numbers. Now, the interesting thing is unless I want to go back to the top of this, unless there is a significant surge in the rate of unemployment, which is currently not in the forecast, the housing market is expected to continue to rebound from 2023 lows. Well, is huge unemployment ever in the forecast? I mean, is that ever something where we're like, oh yeah, you know what, we see a year from now that we're going to have huge unemployment, it's going to cause these problems. So kind of interesting, the way that it's worded. I just don't know if it's ever something that we anticipate, to have a huge unemployment. Now, I will also say that the latest unemployment report that came out, unemployment rate did tick up a little bit for the first time in quite a while. So um, that information came out after this article was released, but that's just going to show that unemployment is showing some signs of weakening. However, it's not nearly at a spot where it's cause for alarm, at least as of yet. Lawrence Yun, chief economist and senior vice president of research for the National Association of Realtors, agreed that there are no indications that a housing market crash is imminent. Now, again, so Lawrence Yun, he's a chief economist for the National Association of Realtors. He's not a realtor himself. Lawrence, I know I'm familiar with a lot of Lawrence Yun's information, his writings. He's published all the time in articles like this. He gets interviewed all the time. He's a pretty good economist. He's got a pretty good handle on things, and I feel like he's pretty neutral and unbiased. However, it is coming from the National Association of Realtors, so I know all my people out there in YouTube land who hate realtors and hate the NAR are going to say that he's biased, and maybe he is a little bit one way or the other. But I think he's actually pretty good at what he does. There is a housing shortage and ongoing job creation, Yoon said in an email. I would worry if there was an oversupply and if we were in a job cutting recession, but that's not the case today. There is one really, really, really important word in this couple of sentences here, and that is this word right here, today. So today, everything looks great. Today, everything is fine. It's not the case today, but maybe not tomorrow, maybe not 3 months from now. Again, major market corrections and recessions don't happen quickly. They don't happen overnight. They take a while to form. So it's likely that this information, the job cutting recession, yeah, it won't show up today or tomorrow, but it could in several months from now. So something to definitely keep in mind when you're reading this stuff is, they're these metrics are all based on today. Another really important thing to consider and to remember is that housing data lags, and we've talked about this a little bit before. So good, reliable housing data is usually at least, at the very minimum, 1 month behind, but it's usually really about 2 to 3 months behind. So if this information is being kind of being developed around this information that's 2 or 3 months behind, well, then it could show that it's not, I don't want to say it's not accurate, because it's accurate to the point where we have the data, but it might not be telling you the full story. So again, something to consider when you read anything related to real estate data is that data typically is behind at least 30 days, if not 60 to 90 days. So just something to consider. According to a Washington Post analysis, home prices have risen 54% since 2019, which led some economists to worry about the potential for a housing bubble that might burst. This right here, 54% since 2019, that's I don't even have words for that. That is unreal. It's unimaginable. That is craziness. And I started off the stream by talking about how there's this kind of this war between people that have houses and people that want to buy houses, and they're kind of going back and forth. And the people that want to buy houses are really hoping for a housing crash. And even though I don't think that's an appropriate thing to wish for, because like I said, there's a lot of collateral damage when you have a housing market crash, a major housing market crash. But I understand. Here you go, 54% since 2019. I mean, that's insane. And I have to say, I'm so glad I bought my first home in 2019 at the end of 2019, because if I hadn't, if my wife and I hadn't bought a home at that time, we would likely, I don't know where we would be. We would be in a much smaller house in a much worse location. That is almost for sure. So I understand the people's feelings that are, part of this, younger millennial Gen Z thing, where it's like, hey, let's go housing crash. They're rooting for it because, they feel that it's crazy. And I don't know if they're necessarily wrong about that. However, even though home prices continue to rise, the pace of increases has slowed. HEP projected about a 3% increase in home prices in 2025, after a 5% increase in 2024. In April of 2022, CoreLogic reported that prices went up 20.1% compared to April of 2021. So as you can see, we are trending in the right direction. So all you millennials and Gen Zs out there that are up in arms over the housing market, at least this is some consolation. It's April 2021 to 2022, there's a 20.1% increase, but then there was a 5% increase, and now we're projecting a 3% increase for the next year, which is about right. I've heard anywhere from about 3 to 4%. By the way, the historical average for price appreciation is about 4 point something percent. It's in the low fours, 4.2 or 4.3% year over year. So that is more in line with kind of standard typical appreciation, which is usually in line with inflation. So that 20% certainly is a huge outlier. Zillow's May home value and home sales forecast actually calls for home values to fall in 2024. Good news for Gen Z and millennials, but only by a little bit, just 1.4% nationally, which is not going to make a difference. And this is another thing to consider too. We hear a lot about this talk of, oh, home prices, might be coming down, or they're not going up as fast. Um, you know, home if a home price comes down by 1.4%, that's not a crash, it's not a recession, it's really not a problem. I wouldn't even consider that to be a correction, because after all, they went up 20% in 1 year. So again, we've talked about this before. If something goes up 25% and then declines by 3%, it's not a crash. You're still up net 22% in a relatively short amount of time. So I don't think it's anything to be alarmed about. If you already own a home, really no need to worry. And the second article that we're going to talk about is actually really, really good. It's going to talk about what happens to you if home values go down, either when you own a home or when you're looking to buy a home. So really interesting article. We're going to hit that one next in just a little bit. So stick around for that one. That's a healthy sign that the market is becoming more balanced, said Orphe. This guy, I'm sorry, I'm not even going to try this name. Orphe D, a senior economist at Zillow, in an email. And I take this person's approach. A lot of times we have people that again, we talked about this on the last stream, where it's like, if home prices go up, they're upset because it's unaffordable. But then if home prices stabilize or come down, oh my God, it's a crash and real estate is rigged. It's like, which is it? And I feel like the people that think, oh, prices are too high, they're too crazy. Having a 1.4% reduction in value is a good thing. Having more inventory come online is a good thing. We're so quick to go from everything is so expensive. We have this huge drought of inventory, and then inventory ticks up this much, and we go, oh my God, we have too much inventory. There's going to be this is a sign of a crash. Well, perhaps there's something in between, right? But again, a lot of that stuff you're reading is on news headlines. It's the media. The media is doing what they do, right? They're stoking the fire of the sensationalism. I really don't think it's going to be a bad thing if home prices do, go down a few percent. That's probably a good thing. A correction, healthy correction, is probably what's needed. A little bit more balance, getting a little bit more inventory on the market is going to contribute to a better balance, and that balance is going to lead to, honestly, an easier time for both home sellers and home buyers. Low mortgage costs, record high home equity, rising financial wealth, and a tight labor market means very few people face mortgage delinquency and would find themselves having to walk away from their homes. This is true. Mortgage delinquency rate is historically extremely low. So, it's just one of those things right now where people are working, people are paying their mortgage. They're typically not having a huge problem. And you have to keep in mind the first rebuttal from my crash bros out there. Hopefully you guys are watching the stream. Um, if you are a crash bro and you're watching the stream, let me know in the comments. Let me know why I'm wrong, or let me know why you think this Zillow economist is wrong. Um, you know, right now people are paying their mortgages. You have to realize that there's a huge, large majority of homeowners out there that have interest rates under 4%. And they're really not going to be affected, even if they do have to take a pay cut or their job is lost. Their mortgage payment is so low and they have so much equity, they're not walking away from their home. I got news for you. They're either just going to sell it, or they're going to refi, pull some cash out, make it work from there. So it's one of those things where I think that you need to keep that in mind. There's a lot of people out there that have homes paid off free and clear, and this whole thing didn't make a difference to them. Interest rate doesn't matter. Prices don't matter. It just doesn't matter to them. HEP anticipated that home sales will likely increase because of expected lower mortgage interest rates and a rise in the number of existing homes on the market. Currently, economic projections for 2025 are also positive, which points to a positive outlook for the housing market, HEP said, which again, for the most part, I do tend to agree with. Housing market crashes, supply and demand dynamics. Some people think the housing market will crash again because the volume of sales has been sluggish, said Rick Sharga, founder and CEO of CJ Patrick Company, which provides market intelligence and consulting for real estate and mortgage companies. About 4 million existing homes were sold in 2023, the lowest number of home sales in about 25 years. Sharga said sales will likely remain fairly weak through the rest of 2024 and early 2025. I agree. I think he's right on point, and I think this is a really good point to make. That people think because there's low turnover in housing that somehow means that there's going to be a crash and like the market's just going to come to a standstill and nothing's going to happen. That's not the case. The reason that the housing market, the volume of sales have been sluggish is because, well, there's not a lot of inventory, and when there's not a lot of inventory, houses can't turn over and can't sell. And housing is very much a chain reaction, right? So when one house sells, another can sell, and then another can sell, another can sell, and another can sell. Whereas unfortunately, when we have limited number of houses, that chain reaction it can be limited. It can be inhibited by the fact that we don't have inventory. So I agree with him on this front. But that doesn't mean current homeowners will rush to sell their homes at a 20% to 30% discount, which is what a lot of doom and gloom prognosticators are predicting, Sharga said via email. There will continue to be demographically driven demand. The country has the largest number of young adults between the ages of 25 to 34 in its history. This is what I've been saying for a really long time, and this is a very, very big reason on why housing is going to be stable and why a lot of signs don't point to a crash anywhere in the next decade. We simply have a lot of young people. And I know what you're going to say. Young people don't want to buy homes. That's categorically false, and it can be proven because go out and ask any millennial or Gen Zer if they would prefer a housing market crash. They're going to say yes. Do you know why they're going to say yes? They're going to say yes because they want to buy a house. So this idea that millennials or Gen Z don't want to own a home, in my opinion, and from my experiences, I am a millennial, and I'm on the younger side of millennials, and I've got a lot of friends who are not homeowners. And I just talked to one last night who said, I would love to be able to own a home. It'd be great, but I just don't see a point to even try right now. And that's what the boat that a lot of people are in. So this idea of demographics is huge. The fact that we have a ton of young people, millennials and Gen Z are a huge demographic in terms of generations in the United States and really all across the world for that matter. It's going to keep the demand for housing up. And even if they're not interested in buying, they got to live somewhere. So they're going to have to rent. And when you rent a house, well, someone's got to own it. Hopefully it's not BlackRock. Demand, while somewhat weakened, still outpaces supply, which has led to home prices continuing to rise despite today's higher mortgage rate. So again, it's a very basic supply and demand problem. The inventory of homes for sale has increased over 30% from a year ago, but it still represents only about a 3-month housing supply, which is roughly half of where the market was in 2019. And this is accurate. This is a really important one sentence. You know, we're still low. So although we've had a little bit of a surge in inventory, which I'll tell you, just in my kind of anecdotal experience, again, for those of you not familiar, I'm a real estate agent here in the eastern part of Los Angeles County, about 30 to 40 miles east of downtown LA. And I can tell you in the last 2 to 3 weeks, we've had a nice pop in inventory. Notice how I said it's a nice pop in inventory, which I think that it is. For the first time in 4 years, 4.5 years, I really felt like, wow, there's some homes to choose from out there. Buyers have some homes to choose from, and there's a little bit of a variety available, which obviously is going to be a huge help to people that are looking to buy homes, and that's going to kind of slow down those insane price increases, because what it's going to do is it's going to give people more options. So there's going to be less bidding wars, and instead of 10 offers per property, we might only see 3 offers per property or 2 offers per property or something like that. So while we are getting a nice little pop in inventory that's going to alleviate some of that stress, still historically speaking, looking back, our inventory is still much lower than what it was pre-pandemic in 2019. So something to consider and keep in mind. In a normal market balanced between buyers and sellers, we would have a 6-month supply of homes, Sharga said. In the years leading up to the housing crash, there was a massive oversupply of homes for sale, nearly a 13-month supply. Okay, did y'all hear that out there? So right now we have a 3-month supply of homes. In the months leading up to the 2008 housing crash and Great Recession, we had a 13-month supply. We have 3 months now, 13-month then. And this is a prime reason on why there's not going to be a major nationwide housing crash. Notice I said nationwide, just like we had in 2008. Are there some areas that are facing some difficulty? Absolutely. And if you watch my stream last week, this will be a repeat. But I do think that the pandemic boom towns are in a little bit of trouble. Those pandemic boom towns being, well, places like Austin, Texas, a lot of places in Texas actually, and mostly in Florida. Those two areas could potentially see a little bit of a price correction or possibly even a crash in some areas. Another area that could be susceptible is areas like Idaho, specifically Boise, where again, these are all pandemic boom towns where people flocked to them when they learned that they could work remote, when they learned that they were going to have to be cooped up in their apartment. It wasn't going to work out for them. So these pandemic boom towns, also including places like Nashville, they could see some significant price reductions. However, on most of your major metropolitan areas, especially those on the East and the West Coast, the inventory is still so low that a crash there is just really, it's quite unlikely. Housing crisis lessons for today. The housing crash that started in 2007 and contributed to the global financial crisis continues to weigh heavily on the minds of many economists and consumers. Yeah, it does. And for good measure. I mean, people absolutely got demolished in 2008 and the years that followed. People got their clocks cleaned, retirements wiped out, businesses closed, bankruptcy left and right, people walking away from their homes, turning their keys into the bank and just saying, I got to get out of this. So I understand why 2007, 2008, 2009 are, resonate so heavily. As humans, we tend to remember the trauma better than the positive, right? So we tend to remember those really bad negative experiences because, well, they scar us, and we typically don't remember the normal good experiences unless they were really, amazing. And so I understand that, 2007 is still heavy on the minds of people, but the factors that led to the crash are not in place today. It's so funny because a lot of the crash bros, I really hope I get a crash bro in the comments. I really do. I really love hearing with them. And quite honestly, I love talking to them. I love hearing their point of view. I love exchanging ideas with them. But a lot of the crash bros will say, everybody, all the real estate bulls, all the real estate agents out there, they're all going to say, well, it's different. It's not like last time. It's different from last time. And they're, crash bros could say, no, it's not different from last time. It fundamentally is different than last time. Literally everything is different about today's housing market dynamics than the conditions that led to the housing crisis, Sharga said. That includes a limited supply of homes. We talked about that. 3-month supply versus 13-month supply. High levels of home equity. Again, we have so much home equity. I could pull up the graphs and the statistics, but it's unreal. The average person has insane equity in their home, which means it's hard to be underwater, which means it's hard to foreclose on. Economic strength, again, we talked about this a little bit. Job market's looking good. The unemployment rate still is slow, even though it's ticking up just a little bit, and we might even be getting a little tiny cut in interest rates here in September, but we'll see. And the strict guidelines mortgage borrowers must meet. This is a really, really big one. The strict guidelines mortgage borrowers must meet. Remember, back in 2004, 5, 6, 7, 8, they were doing ninja loans, which is no income, no job, or assets, which means basically you could walk in to a bank or a lender and say, hi, my name is Mike Smith. I make $140,000 a year. I would like a home loan for $650,000. And the bank would go, okay, sounds good. Here you go. Oh, good luck finding a home. And you're like, oh, okay, that's it. They're not going to verify his income. They're not going to verify his job. They're not going to verify what's in his savings account. They might not even check his credit score. And that was a huge problem when it came to 2007 and 2008. Now it's completely different. It's so different. And if you've gone through purchasing a home between 2012 and today, you're gonna know this. I mean, lenders have very, very strict standards. They're going to check your employment probably 3 times during the course just of your escrow. So when you go to buy a house and you're in escrow, that lender at the beginning of escrow is going to call up your boss and say, hey, does Mike Smith still work for you? And is he still at this position in your company? Yes. And then midway through the escrow, hey, does Mike Smith still work for you? And does he still have this position at your company? Yeah, okay, great. And then right before the close of escrow, they're going to do it one more time. They're going to say, we need to verify your employment. So it is completely different than what we had in 2007 and 2008. And this is just one reason it's completely different, but the lending standards are literally a 180, complete night and day difference between what we used to experience. There are little to no risky subprime mortgages today, Yoon said. Therefore, there won't be an implosion of mortgages. Moreover, most homeowners have locked into low fixed rate mortgages. And I'm glad he mentioned this because as I was reading this, I was like, I forgot to talk about ARMs, adjustable rate mortgages. ARMs were huge in 2006, 7, and 8. I haven't worked with one client that has used an ARM. I don't know of any of the associates in my office that mentioned a client using an ARM. I talk to lenders all the time. Lenders are not really giving ARMs to clients. Yeah, can you get them? Sure, they're available. You can take them, but most people are not. And then my people out there that are going to go against me, my crash bros that are going to be lurking in the comments as they always are, going to say, well, what about buyers that bought their rate down? What about the 2-1 rate buy down, the 3-1 rate buy down, where for the first 2 years the rate is 5%, but then it goes up to 7%? Well, is that a form of an adjustable rate mortgage? Yeah, technically it is. However, you have to keep in mind that those borrowers were qualified at the highest possible rate that they're going to see. So let's say they did a 2-1 rate buy down, and let's say the rate that they were quoted was 7%. They buy it down, they get 5% for the first year, they get 6% for the 7-year, and then it settles at 7%. Two things to remember. Number one, they were already approved at that 7%. So even if they never went to 5 or 6%, they still are approved and they still can afford by the numbers that property. The second thing is most of these rate buy downs were stepped programs. So you went from 5% to 6 and then stopped at 7. Or if you got a 3-year, you went, maybe 5, 5.75, 6.5, and then 7, something like that. So it's not like just overnight, all of a sudden, your mortgage payment has doubled or something crazy, or your mortgage payment's gone up by $800. Is your mortgage payment going to go up? Yes, it is going to go up if you utilize one of those programs, but it's going to go up in steps over time. So it's going to be a little bit more palatable. It's going to be easier to digest and get through. And keep in mind, those buyers were already approved at the highest rate anyway. But most people didn't utilize those programs. Most people utilized the standard traditional 30-year fixed rate mortgage, and that's what they're going on, which means that they have stable monthly pricing. Lending standards are significantly stricter today, Hep said. In addition, most households have much more home equity than in 2007 because homeowners have refinanced into low mortgage interest rates and because of the rapid rise in home prices. So again, if you owned a home in 2019 or before, just in the last 5 years, your home value has gone up 50 some odd percent, which means you've got a lot of equity. Uh, the average loan to value, LTV, is much lower than during the housing crisis, she said. This guy, Mr. D, said that in 2007, homeowners who couldn't afford their monthly payments typically didn't have much equity, which is true. When their home couldn't sell, they couldn't cut their asking price in order to sell their home. As a result, many walked away from their home. So, because they didn't have enough equity, they couldn't lower the price far enough to sell the home, but then still be able to pay off their debt. So, they just said, you know what, forget it. They literally just gave their keys to the bank, walked away from the home, relinquished it, didn't sell it, didn't make any money. They literally just walked away and let the bank deal with it, which was really, really common. And of course, what started to happen is more and more people started doing that. And when more and more people started doing that, we had a huge flood of inventory. And we had a huge flood of inventory that led to that 13-month inventory that we had, which then led to a housing crash. Really quick, I want to clarify what is months of inventory, right? So we talk about 3 months, 6 months, 13 months. Let's just take 6 months, for example, which 6 months of inventory is considered a balanced, healthy market. That is neither a seller's market nor a buyer's market. It's a fair, balanced market. 6 months of inventory means that if no new homes came onto the market at all, it stopped tomorrow, the demand of homes, the demand from home buyers would take 6 months for all those homes to be gone. So if we only have 3 months inventory, that means we have much less. We only have, if we stopped listing homes tomorrow, in 3 months, there'd be no more houses to sell. Again, back in 2007, we had 13 months. Right now, we're sitting about 3 months. Huge difference. In contrast, today, people who sell have plenty of home equity and they can afford to cut the sales price if they need to. The unemployment rate is a low 4%. Home equity is still near record highs in most housing markets. Most homeowners have extremely low monthly payments due to record low pandemic mortgage rates, which is true. Go ask anybody that got their mortgage rate refinanced prior to 2022, mid 2022. They're going to tell you I have a 3% rate. They paid 50% less for their house price or 30% less for their house. There's a lot of people out there that are living in a home that's now worth $500,000 or $600,000, and they're paying $600 a month or $700 a month, or maybe even less, or they're not paying anything at all because they paid it off. As a result, mortgage delinquency and distressed sales remain low. Signs of a housing market crash. Whether you're monitoring your home's value or hoping to buy a new home, you may want to watch for indications of a future housing market crash. An economic shock, such as a major stock market crash or big, prolonged job cuts, could signal the start of a housing market crash, Yoon said, along with large increases in the supply of homes. So let's just go through these kind of like one by one a little bit here. So an economic shock. Okay, now I will say an economic shock can happen at any time. It's absolutely the case. Nobody has a crystal ball. I'm getting freaking tired of that saying, but it does remain true. Nobody has a crystal ball. And at any time, we could have a major economic condition. Heaven forbid a major war breaks out. That usually is a good way to screw up the economy. We're coming up on an election, so we'll see what happens with that. There's all sorts of things that could happen, but it's not likely. Prolonged job cuts could signal the start of a housing crash. Jobs are looking good. We talked about it now. Unemployment about 4%, not a huge issue there. And a large increase in supply of homes. Well, we're certainly not there right now. We're not even close. We're at 3 months supply. We need to be at around 9 months supply to really start possibly ringing the alarm bells for a crash. But still, those are the signs. If unemployment rose rapidly and homeowners couldn't afford their mortgage payments, they could lose their homes to foreclosure if they couldn't sell them, Hep said. A large increase in foreclosures would bring home values down, leading to a potential housing crash, which basically this paragraph just essentially describes 2008. Currently, what may be a concern for some markets is the significant increase in non-mortgage related costs, such as property insurance and taxes, HEP said. That may be a bigger concern for households with fixed incomes who may choose to sell their home if they can no longer afford to make their payments. If a significant number of properties were being listed as a result, that could dampen home prices and weaken a housing market. Nevertheless, with housing shortages still outweighing the impact of these additional expenses, a housing crash is not likely, especially a widespread one. There's a lot of good points made in this short paragraph, and I think he's got a good point. There could be some stress on people related to insurance, which we know has gone up. I don't know, something like 200 or 300% in the last 4 years. HOAs have gotten very expensive. Home maintenance, just in general, has gotten a little bit more expensive. And there could be some people somewhere that go, you know what, I can't do this. The first thought that comes to mind are people on a fixed income in areas that have a high propensity for natural disasters, i.e., Florida. So we know that Florida has kind of been the land of retirement for a while. If there's any Seinfeld fans out there, we know that Del Boca Vista, it's where you go to retire. And if you're on a fixed income and all of a sudden, let's even just say that your house is paid off, right? But you're on a fixed income, a very fixed income as a retired person, and all of a sudden the HOA that you're a part of goes from $140 a month to $300 a month. And then let's say that your house and your homeowner's insurance goes from $100 a month to $240 a month. Okay, that's a problem. That's a really big problem. And there could be a point at which those people go, you know what? I can afford the house. The house is paid off, but I can't afford all the other stuff. I can't afford the HOA. I can't afford the insurance. I can't afford the maintenance and the upkeep and that cost. But I think that the amount of people that are subject to that is a very small pool. And I don't think that's going to create a widespread housing crash. Could it create some localized pockets of price decline? Absolutely, for sure. But is it going to create another 2007, 2008 style housing crash? No, I don't believe it will. Sharga suggests that consumers watch their local market conditions. A very good tip. As we always say, real estate is hyper local, such as whether the population and the job market is growing or declining, along with wages, home sales, and home prices. While a national housing crash remains very unlikely, every market is unique, and some are likely to see prices go down even as national numbers are going up. Probably not enough to designate it as a crash, but enough to make a difference for some homeowners, Sharga said. I think he's right on. I think Sharga he's right on with it. What a housing market crash could mean for buyers. More than one-third of consumers, 35%, believe a housing crash could make it easier for them to afford a house, according to a Lending Tree survey. By the way, if you guys are enjoying the stream, please drop a like. Consider subscribing to the channel if you haven't. It really does help me out. A crash usually means that there is an oversupply of homes on the market and sales prices have plummeted. However, a housing market crash is often accompanied by a recession and job losses, making it harder for someone to qualify to buy a house. Also, homeowners may not want to sell in a down market, which is very, very true. Again, it goes back to, when these people, when I said in the beginning of the stream, these people rooting for a housing crash, I get it. I understand why they're rooting for that, but they need to understand that if there is a major housing crash, it's going to be because we have a major stock market problem, a major economic problem, and a major unemployment issue, or a combination of all of those things. And guess what? That's going to make it harder for you to afford a house, even if the prices do crash. So people, just because, housing market crash, I'm going to be able to buy a house, that's not necessarily the case. The price of houses might get more affordable. Rather, scratch that. The prices of houses might go down, but that doesn't necessarily make them more affordable, because if you lost your job in a huge economic recession, then your odds of being able to qualify for that house significantly are reduced. Still, the possibility of less competition for homes and the potential for lower mortgage rates that could accompany a financial crisis tempts some buyers to hope for a real estate market shift. I will say that the one kind of maybe excluding that is if you are a savvy buyer right now and you are hoping for a market crash, and it happens, if you are good at stocking away the cash that could offset some of the issues that you have, if you end up making less money because of a major recession or there's a lapse in your employment, well, if you're sitting on some good money, that could help to kind of offset the difficulties in the economic landscape if a crash were to occur. So if you're out there and you're hoping for an economic real estate crash, you should absolutely be saving up your cash, because it could help you in the event that something does happen. What a housing market crash could mean for sellers. In a housing market crash, homeowners who don't need to sell may prefer to wait until home values begin to regain their strength. Being underwater on your mortgage, also known as your mortgage being more than what the value of the home is, right? Just like a car. So if your house is worth 400,000, or your mortgage is, you have $400,000 that you owe on your mortgage for your house, but that house is worth 350, you're underwater by 50,000. Being underwater on your mortgage or owing more than your mortgage balance in the value of your home, as many people were during the previous housing market crash, doesn't immediately impact your finances unless you plan to borrow from your home equity. This is a really important little tidbit that will be explained further in the next article that we get to. The bigger impact would be on home sellers who would likely need to drop their prices because home buyers would be looking for a bargain. How to prepare for a potential housing market crash. Here are some tips. If you're worried about when the housing market will crash again, you can take steps to protect your financial well-being, such as establish an emergency savings fund with at least 3 to 6 months of expenses. This is huge. You guys got to have the emergency fund. A lot of people have less than $1,000 in their savings account. That is not smart. You got to get the emergency savings fund up to snuff, because it could really save you in some hard times. Reduce your debt, particularly high interest credit card debt. Pay those credit cards down. They're killing you. I just saw a thing that said there's going to be, some credit card was going to raise their APR to like 42% or something like that. So don't let a $1,000 purchase turn into a $5,000 purchase by paying the minimum on high interest rates. Don't do that. Pay your credit cards off. Make a down payment of as much as you can afford so you have immediate equity in your home, which is why it's great if you can put 20% down versus 5%, but getting into a home is priority number one. Buy a house that you can comfortably afford. There's a big one. Don't overspend. Pay extra on your mortgage balance if possible to increase your equity. And there's calculators out there. Even if you just make one extra mortgage payment per year. So let's say there's 12 payments in a year, obviously 12 months in a year, so you have 12 payments. Let's say your mortgage, I know this is going to make people sick, but let's just say it's $1,000. Keep the math simple. If you made $1,000, your monthly payments of $1,000 a month, but then you just made one extra payment at the end of the year and made 13 payments of $1,000 over 12 months, you're going to pay off your home like 5 years earlier. It's going to save you a ton in interest. There's calculators out there that will show that to you. So a good idea, something to consider. That's one of the oldest tricks in the book, is just pay a little bit extra. It will make a huge difference. Choose a fixed rate mortgage so your principal and interest remain the same throughout the years. Housing market crash FAQs. Is 2024 a good time to buy a house? The right time to buy a house depends on your individual circumstances, such as your job security and commitment to a neighborhood or city. But high home prices and high mortgage rates make it harder to buy a house in 2024 for many buyers. Plus, most markets still favor sellers because demand is higher than housing supply. And this has always been the answer, right? You can't say is now a good time to buy. Only you can answer that. Trying to time the market, is right now a good time in the market to buy? You'll never buy. You have to operate under what is comfortable for you. Is your job stable? Do you have good savings? Do you have enough for a down payment? Do you have enough for a down payment, but then also some left over for maintenance, savings, taxes, things like that? And if you do, then yeah, now's a great time to buy a house. If the answer is no, now is a terrible time to buy a house. So it really comes down to you. There's a saying that we have, it's not about timing the market, it's about time in the market, right? So the longer you're in that market, the more equity you can make and the better your financial investment can do. Whether it's a house or a stock, it doesn't make a difference. how do you know if the housing market will crash? There are numerous indicators to watch to see if housing market will crash again. If demand drops because of job losses or recession, the supply of homes suddenly increases, or there is a major economic downturn that would indicate home values will decline. Will housing be affordable again soon? This is just such a sad question. It feels so hopeless. Will housing ever be affordable again soon? Mortgage Bankers Association predicts that mortgage rates will drop to about 6.6% by the end of 2024. Well, they only got about 4 months to make that happen. We'll see, which will slightly improve the cost of borrowing to buy a house. However, home prices are anticipated to continue to rise, so overall affordability will be a challenge. This is a super interesting article. Again, this is from Yahoo Finance. This just it was a really good one, and that takes me. I want to go to the second article. This one is a lot shorter and really interesting. So this is a wealth of common sense. This is kind of it's this Ben Carlson guy. He's kind of a finance guy, so a little bit more finance related. But I read this and I thought it was super interesting. I'm going to make this a little bit bigger for you guys so we can see. There we go. You might be buying your house at the top of the market. This was the title of a Wall Street Journal that article that was written, and this guy is basically responding to it. So, Buying a House at the Top of the Market by Ben Carlson. Greg Ip at the Wall Street Journal penned a piece recently that warned potential home buyers about the prospect of low returns from current levels. Here's the article. You might be buying your house at the top of the market. Between high prices and mortgage rates, getting wealthy off your home is about to get a lot harder. I don't need to offer any more details from the story because you already know them. Housing prices are up a lot. Mortgage rates are also up a lot. This is a fair warning. We essentially pulled forward a decade's worth of housing returns into the first few years of 2020. And here's a graph that illustrates this. So this is the US nominal versus real housing market returns by decade. Dark blue is the nominal housing market returns. The lighter blue or the brighter blue is US real housing market returns by decade. So you can see we're not even halfway through this decade because it's only 2024. We're already at 49%. All of 2010s was 45, all of 2000s was 47, all of 1990s was 30, all of 1980s was 77. So we're on track to do, over 100%, similar to the 70s and the 40s. Housing prices in the 2020s have already outpaced most decades. On an inflation-adjusted basis, only the 1940s saw higher returns, and we still have 5+ years remaining. If I were a Wall Street pundit, I would say the easy money has been made, but I'm not going to fall for that trap. I don't know if this is some sort of top in the I don't know if this is some sort of top in the housing market. Again, we don't have a crystal ball. Nobody knows what the top of the market is. Given the gains, I wouldn't be surprised if housing prices remain stagnant for a while. Even a pullback in prices wouldn't be shocking. I agree. My baseline assumption is that prices will rise by something close to the inflation rate in the coming years, but predictions about the future are hard. I don't know where housing prices will go from here. I agree with him on that as well. The idea of the top in housing prices got me thinking about what it would mean for those considering buying, selling, or staying put in their current home. Here are two scenarios to consider. Scenario number one, housing prices fall by 20%, a crash. Scenario number two, housing prices go nowhere for the remainder of the decade. So let's game these out and see what happens. How you feel about either of these scenarios likely depends on your current situation or future plans. From the perspective of someone who plans on being in their home for the foreseeable future, me, the author, and also myself do, neither of these scenarios makes much of a difference, which is true. Put aside the fact that a 20% decline in home prices would likely be accompanied by some sort of financial crisis, the value of my home is more or less irrelevant in my day-to-day life. This is something that I try to hammer home to buyers all of the time. Doesn't matter what your home is worth if you are just trying to live, if you're just trying to survive. It doesn't matter what your home is worth if you're not selling it. It just doesn't make a difference. It doesn't matter what your neighbor's home is worth. It doesn't matter what your mother's home is worth. It just doesn't matter unless those people are looking to sell. As long as I can continue to pay the mortgage, insurance, and property taxes, my life wouldn't change in a meaningful way if the price of our house fell by 20% tomorrow. He's absolutely correct. It might take away my ability to tap into equity through a HELOC, but I'm not overly reliant on that as a source of capital. And most people aren't. A HELOC, for those of you watching that don't know, it stands for Home Equity Line of Credit. And basically, what that means is it's when you leverage your house to get cash. So you go to a bank and you say, hey, bank, here's my house. I live at 1234 First Street, and it's worth $500,000. I only owe $200,000. I would like a loan for $200,000. And if I don't pay that loan, you can take my house, or you can take a portion of the equity out of my house. So basically, you're using that difference in what the house is worth. I'm sorry, you're taking that difference in what that house is worth versus what you owe, and that gap we call that equity. So home equity line of credit basically gives you the ability to get cash by utilizing that equity gap. But a lot of people don't use that. Most people don't, because you're going to have an interest rate on that. You're going to have to repay that. You're basically like restarting a portion of your loan over. So people have used their home equity line of credit for things. You can use it like an idiot, or you can use it smartly. I usually tell people that the only good thing to utilize a home equity line of credit for is to buy or improve other real estate. You should absolutely not take a home equity line of credit and then go buy 2 new cars or a new car. That's not good. Cars are a depreciating asset, and that's a throwaway. You don't want to do that. You also don't want to like take out a huge home equity line of credit and then go on a really expensive vacation. That's also not good. You want to try to use that money for appreciating assets. If you need to start a business, that's one thing. Utilizing a HELOC to start a business could be beneficial if the business does well. So just different things to consider. But most people, like the case of the author here, they're not worried about their HELOC. They're not going to tap into their equity. I know I would probably never take a HELOC. I just don't see the need to. I don't see the reason to. It would be a little annoying to watch someone else come into our neighborhood and buy a house on sale for 20% off. Yeah, that would be a little annoying going, it's like when you go to Target and you buy something and then you look in the paper the next day and that's on sale and you're like, dang it, I'm upset. Does it really make a difference to you? No, not really. You still spent the money that you thought you were going to have to spend. And is it annoying that someone else gets the same good for a little bit cheaper? Yes, but it doesn't affect your life any differently. And sure, it would be painful if we were forced to sell the home, sell. Let me start over. And sure, it would be painful if we were forced to sell for some reason, but in that case, all of the other houses would also be 20% cheaper. We would be trading one asset at a lower price for another at a lower price, which is a good thing to keep in mind. Okay, so I'm taking a 20% loss on the house that I'm selling, but there's also going to be a 20% discount on the home that I'm buying. My net worth would drop, but it's not like the equity in my home is liquid anyway, which is true. If prices go nowhere for the rest of the decade, we've already experienced the pulled forward gains this decade. So he's saying even if homes appreciated 0% for the rest of the decade, we've already had 46% according to the graph over this first half of the decade, which is still on par for the rest of the decades. Anyone who has owned a home for more than a few years is sitting pretty, which remains true, which is why it's going to be really difficult to have a major housing crash, because there's such a large majority of homeowners that are sitting pretty. The homeowners who would feel the most pain in either of these scenarios would be people buying right now. You don't have to look back that far in our country's history to see this play out. From early 2007 to late 2016, U.S. housing prices were underwater from their historical peak up until that point. Again, here's this Case-Shiller Home Price Index. And as you see, here we go, we're back in about 2007-ish, and home prices were, this would be 0%, right? So this is even. And we have a low in mid 2012, early 2012 of minus 26% from their high. And here we are in, this is through basically late 2016, it's at 0%. So it took this whole time for us to get back to where we were in terms of pricing. Prices fell by more than one quarter along the way. More than 6 million new and existing homes were sold in 2007. So plenty of people actually top ticked the housing market back then. It was even worse in the hottest real estate markets in the country. Housing prices were underwater in Phoenix and Las Vegas from 2006 through 2020 and 2021, respectively. And here we go. It's basically the same graph, just goes back a little bit further, it drops down, and we're actually still under those figures. There are no sure things when it comes to housing prices. The national housing market might do well for the rest of the decade, while certain local markets struggle. Or certain local markets could remain hot while nationwide prices struggle. Again, real estate is hyper local. You really have to ask yourself why you're buying a house in the first place. Is it purely a financial asset where you're just trying to earn a high rate of return? Or is a house something that provides psychic income as a place to raise your family, live in a specific community, and make it your own? Most people probably prefer financial and psychic returns, but it's not a foregone conclusion that your house will be a wonderful investment, especially from current levels. This is like really important. And he goes on, I'm going to give you my take after I read this next paragraph. I consider our house a place to live, call our own, and raise our kids. It acts as an inflation hedge because we have a fixed rate mortgage and there isn't much land to build on in our area. Plus, paying it off over time builds equity. The price of this house doesn't matter to me as much as our ability to live there for as long as we would like. A portfolio is where investment returns matter. A house is where investment returns are a bonus. This is so well said. I tell people all the time, when they're looking at buying a home, they're looking at buying it as this financial investment. And will I make money? And that's what the crash bros do. The crash bros and the finance guys, they're always about, well, what's the biggest return on my investment? Will I make money in this? And it's like, well, yeah, if it was a stock, I get it. But a house is not a stock. A house is where you live. It's where you raise your family. It's where you sit down to eat. It's where you make memories. What is that worth? There's a certain intrinsic value that you can't define by living in a home. And that doesn't just mean owning a home, but living in a home. Of course, home ownership does have its intrinsic values. You can do whatever you want in terms of, how you want to decorate it, what you want to do, how you want to do the yard, all that stuff. Plus, you get a little bit more privacy, things like that. Plus, it's a hedge against inflation. You have that fixed rate mortgage. You know what your payment's going to be, and you know what to expect every single month. So this last little bit is like really, really important. You really have to ask yourself why you're buying a house in the first place. Are you trying to get the best return on investment? Are you trying to make money? Well, then now is probably a terrible time to buy a house. However, if you're looking for a place to raise your family, have security, you're committed to the neighborhood that you're in, you want to be close to other family and friends in that neighborhood, and you also want to hedge against inflation, well, then housing could be the exact right thing. Oh, John with a nice long comment. Let's see, John, what do you got for us? While I keep tabs on the value of my properties, it is less relevant to me than the market for renting them out. I don't recommend cashing in or selling unless your back is up against the wall. John, you're exactly right. That's the old Warren Buffett approach, which I love. Never sell unless you have to. And you're exactly right. That's a good point to make. It's great to keep tabs on the value of things. It's great to sort of keep your eye on the market and be aware, because after all, it still is your investment. But at the end of the day, it's not going to change your life. And prices of assets, whether it's stocks, whether it's bonds, whether it's houses, whatever it is, it could be baseball cards for that matter. They're going to fluctuate. They're going to go up. They're going to go down. That's just the way that it is. And you can't look at it in the short term. You can really only look at it in the long term. So I think it's one of these things where, people just need to keep that in mind. There's a lot to keep in mind. And the signs are, according to this Yahoo article, we're not seeing any signs of housing market crash. Could something happen? It always could, but we don't know. So I really, really hope you guys enjoyed the stream today. Thanks. I had great viewership today. Again, if you're new to the channel, please consider dropping a like on the stream, on the video. It really does help and make a difference. If you haven't subscribed to the channel, it's absolutely free. Go ahead, hit that subscribe button. I would really, really appreciate it. Just as a little public service announcement note, I'm going to be taking the next couple of weeks off. I am going on a little bit of vacation. It's my wife and mine's 10-year wedding anniversary. We're getting out of town for a little while, so you're going to miss me for the next couple of weeks, but I will be back soon. I promise, and we'll have some more data. We'll have some more stuff to go over. As always, if you need any real estate related guidance or help, I'm always here for you. You can drop a comment to this video. I will absolutely respond to it. If you're looking to buy a house somewhere, I'm a real estate agent, in the greater Los Angeles area. I'm happy to help you. Or if you're looking somewhere else across the nation or world, I have a huge network of agents that I work with, and I can definitely get you in the hands of a competent real estate agent that knows what they're doing. So if you need any guidance when it comes to real estate or mortgages, drop a comment, send me an email. I would be happy to help you. Everybody enjoy the rest of your week. Have a fantastic Wednesday evening, and I'll see you all really soon.